any savings program, and most notably in pension funds, one usually finds that the highest percent of a portfolio is held in government bonds. And there's a reason for that. Government bonds, or treasuries, are considered among the safest long-term investments available. Government and municipal bonds are issued by a country or city government, and when an investor purchases one, he or she is, in effect, lending the government money. In return, the bondholder receives an annual fixed interest payment. The coupon and the face value of the bond does not change. Bonds usually have a due date, a date of maturity. That's the date at which the loan must be repaid. But a bond doesn't have to be held until that date. It can be traded through secondary markets. Not only governments issue bonds, companies also. In fact, any kind of debt entails a bond. The word is closely associated with the Nordic bonda, or peasant. It reminds us of bondsman, bondage, and so forth. Both shares and bonds are issued in a stock exchange's primary market. But whereas shares are mostly traded in secondary markets, bonds are usually traded over the counter. While shares are affected by a company's fundamentals, bonds, corporate or government, are affected by interest rates and credit ratings. Government bonds are also affected by political stability, the value of a nation's currency, and the risk of inflation. The better a country's credit rating, the more valuable the bond. And when interest rates go up, bond prices go down. And the reason for this is that the bond's coupon value, their interest return, is fixed and then worth comparatively less. Bonds can be an excellent instrument to diversify and hedge a portfolio. They usually perform well when other asset classes perform badly. And risk is relatively low compared to shares. And remember, the interest and principal are fixed so as long as the issuer, government or corporate, doesn't default on its loans. When investing in bond derivatives, always consult your economic calendar. There, you'll see the yield offered at the latest auction compared to the yield offered at the one before. This is an indication of the bond's value until maturity, and it will influence the current value of the contract you are trading.